Today I want to go over a basic case study I did on the capital budgeting done by IBM. And the first topic I want to discuss are the investments made by IBM that were specifically made to maintain their competitive advantage in the industry. Over the last 10 years or so, they've made over 100 acquisitions that have helped restructure the mix of business. Their new business structure is focused primarily on cloud computing and software, but they've also considerably invested into their growth market unit that focuses on emerging markets. So they're really targeting Brazil, Russia, India, China, and all the other developing markets. How's their financial performance been since 2002 during the dot-com crash? Well, their pre-tax income has increased by $12 billion. Their cumulative free cash flow has increased by $80 billion over that time, and their earnings per share has nearly quadrupled to just over $10 per share. In 2008, they made a few acquisitions. Their total acquisitions came out to be worth $6.3 billion, and they spent a considerable amount in capital expenditures in their 5 sectors of global tech, global business services, software, systems and tech, and then global financing. And to the left, you can see a pie chart kind of showing their expenditures in millions by sector. $10.6 billion was used to repurchase shares in 2008, and $2.6 billion were issued in dividends, compared to $2.8 billion that were issued the following year in 2009. So we kind of discussed that IBM made a lot of acquisitions to kind of change the business mix that they had. And so we can see here that investment in software significantly increased from 25 to 42% of the business. Services and financing didn't change a whole lot. And then hardware production significantly decreased from 24% down to only 7% of the business. And what can be seen from this is that IBM is essentially getting away from hardware and going into software. Standard & Poor ratings of IBM: their senior long-term debt's an A+, their commercial papers an A-, and their preferred stocks an A+. Aren't the best ratings that a firm could have, but these are all investment grade, so no complaints. Their investment in software obviously has drastically increased over the last few years, and so I kind of want to briefly touch on this topic. They acquired 5 software firms worth $1.2 billion. Half of the $5.8 billion IBM spent in R&D was specifically for software, and then the cost of engineering the software declined from 2007 to 2009. In 2007, they were about just under $400 million, and in 2009, they were a little bit under $300 million. And capitalized software and how it was amortized between 2008 and 2009 was a little different. In 2009, $846 million was capitalized compared to $839 million in 2008, and they seem on face value that they're pretty much the same. There's not a significant difference there, but in 2009, IBM retired $1.14 billion in fully amortized software, which actually offset the accumulated amortization for the year. So in 2009, there actually was higher amounts of capitalized software on the balance sheets. And the IBM stockholder equity, how has that changed in the last few years? Well, there's an increase from $13.5 billion to $22.75 billion from 2008 to 2009. This is primarily due to the increase in retained earnings from a large net income they had in 2009. And just like a lot of other large firms in 2009, IBM seemed to be holding on to the cash they earned. They didn't want to jump into anything or make any drastic decisions. It was kind of the wait-and-see game. And specific segment performance and how they affected consolidated gross income. Global technology services led the way, increasing gross income by 0.8%, software by 0.6%, global business by 0.4%, systems and tech by 0.1%, and then global financing, not surprisingly, actually hurt the firm a little bit, losing 0.1% of consolidated gross income. So all multinational firms have currency risks, and so we're going to touch on how they affected IBM's financials. there was an increased value of local currencies that translated into more U.S. dollars, and so the assets and liabilities of the firm were worth more at the end of 2009 compared to 2008. And then, of course, you have to hedge against these kind of risks. And so, what are some of the strategies that IBM uses? Well, derivatives are basically the popular hedging financial instrument at this time. And so, derivatives are used to hedge currency as well as interest rate risk. In terms of debt and loans, IBM uses a mix of variable and fixed rate financing. So no matter what's going on, if rates are changing or staying the same, they're kind of covered in that aspect, and they're not going to be hurt too badly on either side. And they use cross-currency swaps to hedge against exchange risk. This is a win-win generally for whoever they do the swaps with. And finally, we want to kind of look at their sensitivity analysis. The instruments used by IBM are cash and cash equivalents, marketable securities, both short and long-term debt and loans, commercial financing and receivables, investments, and derivatives. And the process is a pretty straightforward process. IBM uses multiple hypothetical interest rates and measures the effect of the changes on the fair values. And then the change of value is determined by finding the present value of all cash flows affected by the change in interest rates. And that's it.